pockets of opportunity? Where is it that it looks like it needs to be downgraded? We've got Giri, Head of Research at IIFL, joining in on the show right now to talk about exactly that. Giri, hi, morning. Good to have you on the show. First things first, what's been your analysis on how the various sectors have performed, and what are your outperform and underperforming pools? Because it's been quite a neutral earnings season so far, one would say. You've not seen any big upgrades, but you've not seen very big downgrades either.
Well, some sectors have seen downgrades. For example, banks have seen downgrades. If you see our note which we sent you, it's about 6.8% downgrades for private banks during the period that the earnings results were disclosed. So in the 45-day period ended August 15th, roughly speaking. And therefore, there have been downgrades. And IT stocks, IT sector saw downgrades. Then you saw food and FMCG having downgrades. So there have been downgrades. Overall, the Nifty downgrade, um, the large cap downgrades is around 1.8%, and the downgrades are pretty consistent across market cap categories. 1.8% for large cap, 1.5% for mid cap, 2% for small cap. But I think overall the good news is that the pace of downgrades is reducing. By our estimates, the downgrades were much bigger in the earlier 2 quarters. So, for example, small cap downgrades in the last three result periods have been minus 4.7, minus 3.7, and minus 2. So that's improving. The downgrade upgrade ratio is also improving. So 4.2 times downgrade to upgrade ratio 2 quarters back, that improved to 3.5 times 1 quarter back. In this quarter, it's only 2.1 times. So on the earnings delivery front, we are not so bad as I expected it to be. So broadly, I think these numbers beat my expectation. Maybe the street was a little ahead. So when I'm saying these downgrades happened, I'm talking about the consensus numbers. We don't cover all the companies in Nifty 500, NSE 500. So broadly, there have been downgrades, but it still beats my expectation. I think the earnings momentum, which was flagging all this while, might have one more quarter of weakness because of this GST proposal potentially creating a consumption deferral. But after that, I think the momentum should come back, and 3Q onwards, we should be looking up.
You say, Giri, looking up, and the fact that you think that the downgrade cycle is now beginning to reverse, where do you think the first signs or the first, fillip is actually going to come in? You talked about staples, or you talked about the larger consumption theme, but if you could just analyze it a little bit more, in a micro fashion.
Yeah, at a macro level, see, there are some guesses about how long the lag effect of the income tax cuts will be. The income tax was cut by about 1 lakh crores, although overall fiscal deficit was only compressed, but still that is a more a consumption-oriented push. Then this GST will probably also kick in by Diwali, as Prime Minister Modi says. Then we have, maybe some resolution possible in the Trump tariff angle. In your own newspaper on Sunday, the front page headline was that Trump might not put the tariffs on India. So, and also we see some of the other instances of the government taking revenue from people, like, online gaming. If it is banned, our estimate is that around 50,000 crore of revenue to the government could probably come down. And that is also a stimulus to the economy in the direction of consumption. So all of these things tell me that we'll see the macro part play out first in consumption. We have chronically been underinvesting. Our capex to sales picked up briefly, but more due to PSUs and the government. The private sector capex has been quite poor. That might start changing in FY27. So I would play those stocks and those themes a little bit with a lag. For now, the first ones to react should be the broad consumption themes, particularly the discretionary category.
Giri, hi, morning. So I agree that the consumption names on the back of this GST boost that we're seeing can also react going ahead and meaningful recovery. In fact, we've heard some of these staples managements also start flagging off that urban demand has started to come back. It's looking good on that front. But Giri, another sector that could be in focus going ahead is insurance, because so far in quarter one, financials have been rather mixed. It's not been all that great, but not all that bad either. And insurance, of course, on the back of this GST boost could be in focus. Where do you think the entire financial pack, including insurance, could be headed in the quarters to come?
On the financial pack, things look good to me. For example, I would think that the market places an unhealthy degree of emphasis on near-term earnings for banks. And while banks have had their share of problems, the two big problems, um, one, the extreme compression in required for HDFC Bank's loan to deposit ratio to come down to the early 90s should be accomplished by somewhere in the last part of FY27. So there'll be an improving trend that is visible, and that will probably just ease the pressure a little bit on the system. Second is this emphasis on earnings because the loans got repriced lower after the interest rate cuts early. Next year, the deposits will also get repriced rapidly, and therefore the FY27 over 26 EPS growth for the private bank should be very strong. So that will be one part. And therefore, I think the banks as a pack should stop underperforming, or at least the best banks of them, among them ICICI Bank and HDFC Bank, should start outperforming. And second one, as far as your question on insurance is concerned, yeah, the GST will be a problem for them if the GST is cut from 18% to 5% or 0% as the hope seems to be. For other companies, because of the inverted duty structure that will get created for insurance companies, there will be a time for which they are cash out. But the refunds in GST, if you see the figures for FY26 so far, are happening at a rate of about 16,000 crores per month. So the companies that end up suffering from the inverted duty structure, they have a lag, but they ultimately do get the money back as the GST refund. So the insurance companies will not have to ultimately suffer, but initially they'll be cash out a little bit. But insurance is one of the sectors where the volume growth is likely to be well above the average for the economy. So I'll be very positive on insurance, particularly SBI Life. So from this pack, I were to pick the banks. I would say ICICI Bank, HDFC Bank, and SBI Life. On the non-banks, I would say there is a good chance that we see a pickup in consumption in autos, particularly, and that could help the volumes for NBFCs. The savings also will go because of the lower price and the lesser load on the wallet into improving their creditworthiness. So NBFCs will also prosper, and in general, they do well when interest rates come down. And I think while we won't see any more rapid rate cuts, that was my earlier assumption. But now, because of this GST stimulus likely to come in, we may not see the RBI cut rates that much. But whatever they have eased till now will go to the benefit of NBFCs. Chola Financial would be my top pick.
Interesting. Giri, you did talk about ICICI Bank and HDFC Bank, but let's talk about the disappointments as well from within the banking sector. Do you think the MFI stress, which we've seen pretty much across the board, is not going to go away in a hurry?
That's a fair thing to say. I think it's a two-quarter problem, and after that, with the I'm not very sure about the direction in which the SME sector will be impacted. The government has very clearly said that they want to help the SME sector, and some of these sectors like auto, which have very high gross margins, they have a very large SME-based ecosystem supporting the main listed companies. So if the GST load on that sector goes down, then the SMEs also benefit. So the benefit should come from there. But broadly, if you see, there will be also an unorganized to organized movement because of the GST cuts. GST rates being high was one of the differentiators for listed companies or the mainstream companies. But if that changes, the SME sector of the economy gets a negative impulse. So at this point, it's a little difficult to say the rural economy how it will do. I'm slightly more optimistic because with the general economic revival I'm talking about, which should start from January, the bottom end of the economy also should pull through. Specifically on MFI, I would say that I should probably pin down a two-quarter time before which we start seeing uh, stabilization in the credit cost metrics in that segment.
But Giri, since you just touched upon the auto space as well, help us understand that what within the auto sector you are liking at this point in time, because segment-wise, the two-wheelers have been doing well. The competition is expected to increase in the passenger vehicle side. How are you penciling in all these things? And add to that is the GST rationalization.
I think one of the problems for the auto sector was this threat that EVs will come and swarm the market. That threat has probably got diluted because the IC engines based cars will now be having lower GST. The smaller cars will benefit. Maruti has a greater salience of sales in the small car segment. So the bigger cars might still continue to be taxed with heavy cess in the 28% GST. Maybe the whole thing will move to a 40% rate. And therefore, I think the company that seems to be best placed in the way I look at it is Maruti. I would also say two-wheelers, but what holds me back is the fact that the two-wheeler companies have been losing market share, and the only ones which are gaining are TVS particularly, and they'll probably do well. But there are other problems with TVS, like a peak margin and so on. Keeping all these things in mind, I would say the companies which are best placed from all points of view are Maruti and Hyundai. Hyundai is the one we would favor a little bit more because we think that their new capacity coming up in Pune, plus the export focus, will lead to category leading volume growth for the company. And all other companies will maybe also do well because of this GST push. But the top of the line will be, top of the pack will be Hyundai, closely followed by Maruti.
Giri, this big talk in the market about the GST rationalization and its impact on the entire consumer segment, right? And then there is also the divide in the market as to whether you even look at traditional forms of consumption via staples and just white goods, or do you play them via the digital economy, the PB fintechs, Paytms, Swiggy, Zomatos of the world? Where do you stand on this entire debate?
Yeah, we like Swiggy and Zomato to just come directly to the stocks because I think they had a very strong inherent momentum. Plus, in the case of Swiggy, some valuation comfort also. We see that if you do a sum of the parts on Swiggy, the quick commerce business seems to be available at a very low fraction of the estimated value of Zomato's quick commerce business. And that much of a difference is not justified because the size of the businesses are not in that ratio. So Swiggy should have a significant upside. And so should PB FinTech. The overall structural argument for online to increase its presence in the economy and PB FinTech to continue maintaining a dominant share, that doesn't change at all. And therefore, while the stock has not done much for a long time, I think now the accumulated underperformance will probably give way to outperformance beginning from here. And therefore, these two companies, yes, Zomato also, as a general theme, online was anyway strong. And to your point on GST, yes, the GST has benefited the older economy companies initially, and the stocks have reacted and probably have reached a higher level so that initial thrust is used up. Incrementally, I would be back to arguing that the online space, particularly the two companies I mentioned, maybe also Zomato, would continue its superior performance.
Let's focus from there, Giri, and want to ask you on pharma. Now, you have a positive coming in because PM Modi in his Independence Day speech mentioned the need for affordable pharma and healthcare back home. On the global front, we still don't have a lot of clarity on the timeline of pharma tariffs coming in from Trump. Given that this sector right now is looking slightly positive on the back of PM's comments, how are you positioned when it comes to pharma, or are you still waiting for more clarity on tariffs and you've adopted a wait and watch approach maybe?
We've had an approach which I don't see the need to change, which is that at the top of the pack are the hospital companies. Number two are the India-focused pharma companies like Torrent Pharma. Number three come the small companies in the diagnostic space, and the US-focused pharma companies are the last in our order of priority. And there were various reasons. One was that the competition was going up, the number of ANDA filings were going up, the number of ANDA withdrawals were going down, and Trump came and threatened a big tariffs on the pharma, and rev limit and all were one-offs which the market seemed to be placing too much importance on. So for all these reasons, we categorize them as the lowest priority. Many of our cells are from this sector. The diagnostics are very small, so I'll focus on the other two. The India pharma names look good. The best pick, in my view, is Torrent and JB. And after their merger, they'll realize synergies which people are not building in. And we should probably see a 20% CAGR stock price return over the next couple of years. And as far as the best sector of the lot was concerned, we thought it would be hospitals, and we continue to think so. Because, like I said, the GST impulse to stock prices already over and done with. And now incrementally, if any surprises come, the stocks will react. But we are broadly mark to market on that. And we should go back to where we saw earnings momentum being very strong. If you see the hospital sector, there are many things going for it. They are able to deleverage despite gains, and despite that, they are able to deleverage. The operating cash flow to capex ratio has kept on going up, and the inherent momentum is supported by very low penetration. The top 10 companies are only about 10-15% of the total market. The market size is about $75 billion. So long way to go for the big listed firms. And therefore, nothing really changes after this GST. I think our view remains pretty much unchanged. Apollo Hospital and some of the smaller names also, like Rainbow and Kim's, are the stocks we favor. They've done exceptionally well in the last couple of years that we've been recommending them, and also in terms of their operation metrics and profitability in the last few years. It's one of the most shockingly spectacular outperformers. If you look at the ROC and all, they're up by 20, 30 percentage points. In no other industry do you see that kind of jump. Have you seen that kind of jump? And while that jump is over and done with, the hospital stocks, you've got to be selective about it. So I'm talking about Apollo and Rainbow and Kim's only. They will probably do well in the entire pharma and healthcare space.
It is, and very quietly, gradually, they're now all sitting at their all-time peaks. But Giri, what about the part of the market that you don't want to touch right now? I bet after the earnings season, somewhere conviction would have only gotten stronger to completely avoid those spaces.
Yeah, I would say that there are some spaces. I mean, I'm beginning to consider it to be more and more difficult to see spaces that won't do well. Because I think, like I'm generally talking about the economy, I feel that there are indications that the market itself has sort of bottomed out. And while it continues to be an expensive market, you know, at least for the next 6-8 months, unless there is a big negative impulse, the market won't derate. But the laggards could probably include IT. I think what President Trump's tariffs have definitely done is to give a big knock to the capex programs globally and in the US. Now, incrementally, you see the tech companies' stock price performance also faltering. They've done all too well. Most of the tech spending in the US, $120 billion per annum by Microsoft on capex, is all concentrated in the big seven companies, and the rest of the economy is not doing well. The GDP growth is down to just a little bit over 1%. The S&P 500, X of the top seven companies, tech companies, are actually tumbling. So in all these ways, I think the problem for US economy's growth will become front and center more and more. And the IT companies will be hit by that. You'll probably see more downgrades. And although they have underperformed by 15-20% YTD as we speak, there is more to grow. And that is one sector that may not do very well. And chemicals is another sector. US focused pharma is another sector. And at least for the next 6 months, I don't see the capex companies picking up. They're quite expensive. They'll do well next year. But immediately, the market seems to be, latching onto the early reward stories, and capex companies might not quite feature there.
You mean government capex beneficiaries, right?
That also, yeah, absolutely. Because the government, if it is giving a fiscal impulse through GST, they may not do the same thing in capex with the same intensity. Let's not forget that in the budget twice last year, in February once, and then after the elections in July 2024, the government twice promised 21% capex growth, but they ultimately delivered only 4% for the central government and 3% for the state government, which is a shockingly low number. So that risk is not gone. FY26 may not carry any major acceleration on government capex. Private capex, I think, will really pick up only next year. We'll have to wait and watch. They'll have to convince themselves that the demand has grown. Demand has been very poor. Company after company has been painting a sorry picture of what they see of demand. that could change with GST and maybe the lag effect of income tax cuts. Now, I'd also probably say, the 50, 60,000 crores tax outflow from the spend on gaming that Indian consumers were doing. And, maybe tongue in cheek, one can also mention that Jane Street was siphoning off a lot of the profits that Indian retail investors were willing to squander on options trading. SEBI's estimate was that 92% of the Indian investors made losses in options. So Jane Street was pocketing all of that. Maybe they won't pocket that anymore. So all of that will come into consumption. That's the pack that will react quicker. So when the time comes for capex, we'll be watchful. We'll warn you in advance.
Oh, absolutely. You don't have to be tongue-in-cheek about it. Quite obvious that, they did have their impact, whatever they did. But Giri, so good having you on the show. Thank you so much for your time today.
Thank you.